Yacks and the Fed Yacks. Welcome to Smaulgld's. In case you missed it, top gold and silver stories for the week ended September 10th, 2016. Well, the top story of the week was the presidential campaign heated up between Senator Clinton and Donald Trump. Miss Clinton went to Cleveland earlier in the week and she attempted to give a speech which was interrupted for about 5 minutes with a severe hacking cough. She also attempted to give a impromptu press conference with the members of her press cadre on her plane, and that too was interrupted by a coughing fit which ended any questions she might have been taking. So the mainstream media scoffed at the concept that these coughing fits had anything to do with her health, because her health and any issues with her health have been debunked. So there's nothing to see here. Move along. Of course, the alternative media made a big issue out of it as further evidence that Hillary is indeed sick. Also riling up the media was the picture of the press corps fawning at Hillary Clinton during the press conference she had on the plane, asking her, how was your weekend? Are you all ready? Instead of asking her the hard questions like, why did some of your staffers smash iPhones with hammers after there was a request for information? In any event, I put out an interesting tweet here. On that picture, looks like they're all having such fun. Later in the week, actually today, a story broke that Hillary Clinton called Donald Trump, or half of Donald Trump's supporters, a basket of deplorables, saying that they are either or any of all of the above: racist, xenophobic, Islamophobic, homophobic, and whatever other ism or obics they might have that she does not think they should. Top economic story of the week, moving on from Hillary's hacking, is the Fed reinjecting themselves into the dialogue and putting themselves front and center that there is a rate hike coming. There's always a rate hike coming. There's been one over the last 10 years, but the next one is always around the corner despite the data. We'll get into the two yak attacks that happened during the week. The first one failed. The second one was successful and managed to drive the price of gold and silver down and finally boost the dollar, because that's ultimately what the Fed wants to do. Is they need to talk the dollar up so that when they finally launch their massive 2 trillion, 4 trillion asset buying purchase program, the dollar won't collapse from a low level. It'll fall from a much higher level. Gold and silver. By the way, if you're not a Smaulgld subscriber, please subscribe to Smaulgld. Just put your email address in here. You will get breaking stories like the ones we broke on the Swiss National Bank holding gold and silver mining shares, on the Norwegian bank doing the same. We've broken stories on PayPal. We've broken stories about governments harassing and tax authorities harassing precious metal dealers. Smaulgld, in many cases you get it first. Sometimes you see Smaulgld stories later on in alternative media with a lot of hype added to them. I try to put the facts down and also add clarifying information. So if you subscribe to Smaulgld, you'll be one step ahead of the stories when you finally see them elsewhere on alternative media and they're all dressed up in some type of hype. Gold closed the week last week actually up. Now gold had been up big time during the week, but on the basis that the week prior the jobs number that had come out on Friday was bad, and Fed Vice Chair Fisher had said that that was one of the numbers they were going to be looking at. That was consistent with Janet Yellen's talk at Jackson Hole that the Fed was looking at raising rates soon. And Mr. Fisher made us all believe that that number was important. Well, that number, if it was important, came out it was bad. So markets rightly took that as a sign that, well, they probably shouldn't raise rates, won't raise rates according to the way the Fed thinks at the September meeting. So gold shot up, especially on Monday, not so much on Friday after the release of the number, but Monday and Tuesday it went up, and so did silver. And the yak attacks later in the week attempted to reverse that because the dollar index had fallen after the jobs numbers came out, and as we'll see later as we go through the daily reports, The other data that came out during the week wasn't very good either. The ISM manufacturing showed a contraction. The ISM services showed a big miss and a decline almost into contraction territory. So that kind of, by the middle of the week, people were convinced that there's no reason the Fed would think, if they're data dependent, they're going to raise rates. So the dollar index fell more and the gold and silver prices rose. But of course the Fed can't have that. So they launched their yak attacks, and we'll see them in real time as we scroll down and look at what happened during the week. Last week, I'm sorry, we did not get to go through this. We had a technical issue where the scrolling feature did not work on the podcast. But what I wanted to show was we had done a story about JP Morgan and the silver either owns and or controls, and we listed the silver that's available to them through their COMEX warehouse holdings, through their gold and silver mining shares. And one of the things I had shown last week was this chart and the COMEX available eligible silver in the warehouses that are COMEX authorized. And you'll see it's at it's at 135 million ounces, which is the most it's been probably ever. I don't have data that goes back that far, but it's at least the highest it's been since 2006. But the point I wanted to show last week, if you guys didn't go to the website and look at the charts, was that JP Morgan Chase, their depository, their COMEX authorized depository, owns more than half of that, or has more than half of that eligible silver in its depository. So they have over 70 million ounces of the 135 million ounces that are eligible to trade on the COMEX. Another reminder to sign up for Smaulgld updates. Okay, earlier in the week, I had done a interview with Kennedy Financial. A lot of topics covered, including real estate. One topic that we spent some time on was gold and silver potential confiscation by the U.S. government. We discussed the distinction between the 1933 gold confiscation and the 1934 silver confiscation, which most people aren't even aware of. And today's, I'm not going to go through the differences. You can click on this link or this link and read about it, or you can click here and you can listen to the podcast. Again, I won't go through all the links on this page, but there's a lot of good gold and silver stories. So please click on the link below this podcast and you can scroll through at your leisure and pick the stories that you're interested in reading about. I will only cover certain highlights. But here's what I do want to cover. Central banks, Wall Street Journal, equities could get a boost if central banks start buying. Excuse me. And they talk about this, that this is a good thing. Well, it's a good thing if you own stocks or you want the stock market to rise. But the point that central banks, they already are buying. Bank of Japan already owns a good chunk of the Nikkei, the Japanese stock exchange. Swiss National Bank owns 63 billion of U.S. equities. We know the Norwegian central bank and its sovereign wealth fund owns a good chunk of shares. We know that the Chinese sovereign wealth fund, we don't know what their exact holdings are. They invest in U.S. shares. So central banks and governments are already invested in the markets. But what's interesting is you have the Wall Street Journal cheering on this on as if boosting equity prices really has anything to do with the real economy. I mean, you can have the share prices of these companies go higher and you can have the economy come to a standstill. It doesn't seem to bother these people. They just want to buy any asset they can possibly buy because they think somehow buying these assets drives up prices. Now, the real danger in governments buying equities in large amounts is eventually they'll have shareholdings that'll give them control over these companies. They're not buying non-voting shares, they're buying regular shares, and at some point they can control the company. They can select the directors who select the management, who create the policies, and they can create policies whereby they could say, well, the company needs to issue more debt. Okay, they issue more debt and the central bank buys it. So you can see there's a vast potential for conflicts of interest and just basically nationalizing not just the stock market, but the companies that are in the stock market. They can play favorites, they can give subsidies, they can change the policy so profits aren't important. Why worry about profits if you can get a funding through an IPO of shares in which the central banks also participate? You get your money that way. You don't need to make profit for your money. You get it through doing equity issuances, and you already got a ready-made buyer. You got central banks will scop up those shares as soon as you issue them. Okay, let's see what else we got. All right, so now you have Indian gold exports down 60% through August. this is part of the trend of all physical demand for gold and silver this year is down across the board in India and China, U.S. Mint, Perth Mint, and so on. And you can see here, look, this is 2016. You've horribly low import numbers for gold. Now people are saying, oh, but there's smuggling going on, it's not captured. Okay, sure, but this 13%, this 10% import duty that the Indian government placed on gold goes back to 2013, and during that time they had very good, almost record years of gold imports into India despite the tariff. The reason Indians aren't buying now is because with the 10% tariff and the 25-30% gain in gold prices, it makes gold less attractive to buy. So they bought when it was cheap. They don't buy now that it's more expensive. It's pretty simple. Silver imports into India down 50% this year. Now the silver isn't subject to the 10% imports. You can't explain away the declining silver imports on the fact that there's an import duty. So both precious metals in India are down this year. They were way up last year. The price was down. They're down this year because the price is up. There's your charts. Here's another concept. Bloomberg says central banks are expected to save the world and make governments money. Exactly my point. Central banks, people are conditioned to think, can fix everything by their monetary policies, which now aren't even monetary policies and setting interest rates, but they're buying assets. And if they buy assets, if you think about it, next time there's a stock market crash and they buy assets, they get to buy those assets on the cheap. The fact that they're buying assets drives other people into the market, raises the price, they make money. They can create a crash, and then central banks can then buy the remnants of the stock market crash. So if there is a crash, expect to see the central banks piling in to equities, and government makes money that way. As we mentioned, ISM, non-manufacturing, almost into contractions. Anything below 50 is a contraction. It was 51.4. Expectations were 55. The last reading was 55.5. So you see it's going down. Why would the Fed think that the economy is solid, robust, full employment, moving higher, when you've also had two GDP numbers, the first quarter and the second quarter at 1%, 1.2%, whatever it is, it averages out to about 1%, which is not solid growth. It's not a sign that the economy is moving forward, but yet they've got the GDP, Atlanta Fed at 3.5%. Cleveland Fed President Meister thinks we're going to get 3% plus growth in the third and fourth quarters. Well, we're almost done with the third quarter, and we've seen nothing to indicate that there should be an increase in GDP in the third quarter, other than if they want to manufacture an increase. U.S. Mint sales update. This is part of the trend I talked about last month when we reported the August sales for Silver Eagles. They were down again from July. They were down in August very significantly. The gold sales kind of rebounded in August, and my theory is that gold sales in physical form in the U.S. Mint will continue to rise as we move into the fall months where people get nervous, because gold is the go-to metal when people are nervous, far more than silver, and there's still backlog issues with the amount of silver. So the gold sales this month so far are 17,000 or 19,000 American gold eagles sold, and only 310,000 American silver eagles, and that's the 1 ounce American gold eagle sales. And the ratio is down to, the gold to silver sales, the silver to gold sales ratio is only about 15-1 now, and that number was as high as over 100-1 when they were selling so many silver eagles and very little gold. That trend seems to reverse, that people are now putting their money into gold as they move into the fall season. Perth Mint sales down tremendously the last 2 months. As you can see, in August, 376,000 ounces sold versus 707,000 ounces sold last August, and last August reflected a month before the Australian silver kangaroo was issued, which turbocharged Perth Mint sales. Well, there was no such hop along here in this month, and again the Perth Mint mentioned that there's just not the demand and that dealers are well stocked. So silver seems to be in a glut phase where people loaded up on silver early in the year. Dealers loaded up on it, Indians loaded up on it, and the price rose, and they're having a hard time getting rid of all of it. Now, if you're interested in buying them, you can buy them through the Smaulgld site. If it's an appropriate thing for you to buy, click here. You can get some of these Perth Mint silver kangaroos. People's Bank of China, another issue where you have declining physical gold demand. People's Bank of China is not China. It is the Central Bank of China, but it has reduced its foreign reserves. Even though it's still increasing its gold reserves, it's increasing them at a lower pace than it was last year. It's shedding some of its U.S. treasuries, but these numbers reflect a decrease in the pace of gold acquisition this year versus last year. You can see all these months, they were much higher. They were 19 tons a month, 21 tons a month, 19 tons a month. One month this year, they did none. The last 2 months, they've only done 5. Now, I know that people say this isn't, they're lying and this is not, doesn't reflect China's gold. Of course it doesn't. And again, this is another story that Smaulgld broke when China first released, or the People's Bank of China first released their official gold holdings at the People's Bank of China back in June, July last year. I had a story published in Zero Hedge called The Case of China's Missing Gold that went through where the rest of the gold could be. Now, there is gold elsewhere in China. China is a communist country. They own basically everything in the country. So there's other Chinese state-owned banks that have gold. There's a Chinese investment company that owns gold for sure. There's individuals that own gold. This is just the gold that is on the Central Bank of China's balance sheet. And they're adding less gold this year than they were last year. And of course, China is the #1 gold producer. They produce 450 tons a year of gold that doesn't get exported. They import massive amounts of gold through Hong Kong and Shanghai. There's large volumes on the Shanghai Gold Exchange. Clearly, all that gold doesn't end up at the People's Bank of China's on the People's Bank of China's balance sheet. It ends up elsewhere in the country. But also, if you look at we're going to go see this in a second, the Shanghai Gold Exchange volumes are indeed lower, 29% year over year, lower than they were last year. So there is a decline in physical gold sales, irrespective of what you think of what the People's Bank of China is lying or not. There is a decrease in physical gold demand in China, imports, Shanghai Gold Exchange, decrease in India, decrease at the major mints as well. And there's a video on the People's Bank of China I did earlier this week. Another quick YouTube I did earlier this week was, is the mining craze curbing physical gold and silver demand, possibly highlighting that a lot of silver stackers transferred a portion of their discretionary investment money. Instead of buying the physical gold and silver as those prices rose, they might have bought mining shares. There's other reasons. Perhaps in this is meant to be thought-provoking, not definitive. It's just not even my opinion, just listing some of the reasons why physical gold and silver sales might be down. Now, Perth Mint gold sales were also down 53% in August. They were at their lowest level ever. And you can see here, there they are. Lowest level, at least in the last 6-7 years from which I have data, only 14,000 ounces of gold sold at the Perth Mint in August. Story about gold nuggets or a gold nugget being found in California gold country. There's a couple of links there. You can check out the pictures of that. Platinum's discount to gold lures Japanese jewelry lovers. Now, if you're interested in platinum is indeed trading at a discount to gold. It normally, historically, maybe 85% of the time, trades at a premium to gold. But in the last over a year, it's been trading at a discount. Platinum is 10 times more rare than gold, but it does not cost 10 times more than gold does. And that again shows that people who think that somehow there's a gold-silver ratio and it's out of balance because silver is not 70 to 1, is not more abundant by 70 times than gold, and therefore the price should reflect that. That's not necessarily true, because as you can see with platinum, that argument would mean that platinum should be 10 times higher. It doesn't mean that. It means if people want gold more than they want silver on a relative basis, silver will be priced higher, irrespective of the physical amounts that may be available to buy. Another example I give that makes it even clearer is my artwork is 1,000 times rarer than Picasso's. I have very little artwork. It's not good at all. And Picasso produced a prodigious amount of artwork during his lifetime. Yet, even though he's produced far more art than I have, his artwork is worth multiples more than mine. Mine is worthless, and his is worth a lot of money. Now, that's an extreme example, but I think you get the point that if silver is less desired than gold, then the ratio will reflect that, irrespective of how much silver or gold physically is available. All right, let's move on now. Further in the week, let's see where we go. Perth Mint sales we mentioned are down. People's Bank of China acquisitions are down. Perth Mint Gold sales are down. We just discussed platinum. If I was going to mention, if you're interested in platinum, you can go up here and take a look at the gold versus platinum ratios. I have them going back 50 years in charts. There's a live ratio, gold to platinum ratio. There's also a platinum supply and demand 2015 report. You can check out all the information about platinum if you're so interested in learning about the other white metal. There's three white metals, precious metals. There's silver, platinum, and palladium. Now let's get into the first yak attack of the week. San Francisco Fed President Williams, U.S. economy is in good shape and he wants rate hikes, an increase on the table in September. Fed's lacquer, case for rate hike is strong in September. Now, during this time period, the markets kind of listened to these guys and they said, okay, you always say this. That's nice. Thanks for reminding us that you still exist and I know, we get it. You're going to raise rates. Yep, you're going to raise rates. Nothing really happened. Gold continued to go up. The dollar index fell. Williams and lacquer did not manage to change the dynamic that people saw, that the ISM was down, that the jobs report was bad, and they thought, you guys got to be kidding me. Excuse me, you're talking about rate hikes, economy in good shape, and we're getting this data that shows that it's not. Then we have further information comes out. U.S. probably added 150,000 fewer jobs in the year through March. Reuters, Bloomberg, the U.S. job market was probably a little less robust, even though the economy approaches full employment. Now, a lot of the Fed officials are relying on the fact that they're saying that the economy is at full employment. There's record job openings, but irrespective of those numbers, whether you believe it or not, they're not translating into economic growth. So they keep saying it's going to, it hasn't, and looks like the job creation train slowed down also in August. U.S. Mint sales, again, they reflect a lowering of American Silver Eagle sales, but it looks like the American Gold Eagle sales are on the up and up. And by the end of the month, I think and the end of the week, at a ratio of about 15 to 1, which is pretty good, meaning that there were only 15 American Silver Eagles sold for every one American Gold Eagle, which does highlight that the Silver Eagle sales are down relative to prior years and the Gold Eagle sales are up. Yellen said something about, she tells Congress, Fed wants to bar banks from owning physical commodities and equities, and my retort to that is, yeah, because they don't want competition when they go to buy them in their next round of QE, where they decide they're going to buy $2 trillion to $4 trillion worth of whatever they need to buy in their next round of QE, if indeed there ever is the remote possibility that there's a recession. The European Bank announced that they're going to keep rates on hold, and they're doing the same trick as the Fed. They're trying to pretend that, yes, we have a set date to end our own QE. That date is March 2017, but they did mention that they will continue to buy until the end of the date or beyond. Okay, so they leave themselves wiggle room to continue printing money and buying bonds, and even if they have to expand their bond buying or perhaps equity buying, expand into equity buying. Silver, as I mentioned earlier, silver imports declined by half in 2016 as traders offload old stock. Mexico making noise. This isn't Mexico. This is a Mexican lawmaker. He's probably in the parliament or whatever they have in Mexico. Considers ripping up its 1848 agreement that transferred half of its territory to the U.S. if Trump wins election. Okay, so that's actually a declaration of war, which I doubt the Mexican government would want to willingly enter into just because Trump becomes president. Initial claims, again, they're always down, and that leads Reuters to pound the table. It points to sustained labor market strength. No, it just means there's fewer people left to fire, and people have already, if they've left the labor force, they stopped applying for benefits. They're only entitled to unemployment insurance once. If they don't get another job, then they can't go back and reapply. Consumer credit rises to 18 billion, student loans rise to 2.4 trillion. So you can see that the economy is based on cheap money. A lot of the consumer buying or spending, which they call, it's robust. It's based on borrowed money. It's not based on people making more money, people getting jobs, spending that money into the economy. It's based on buying cars on no money down and zero interest rates on their loan, or just stacking up charges on their credit card. And we scroll down, we're almost to the end of the week where we get into the yak attack. Shanghai Gold Exchange, as I mentioned, withdrawals fall 46% in August. They're down 29% year over year. Now, Shanghai Gold Exchange withdrawals of physical gold from the exchange, they are a proxy for physical gold demand in China. And as you can see, they're down. If you're interested in buying gold, you can do it through the Smaulgld website. You can compare dealers. You can also do the same with silver. If you do that, I get a small commission. So if the buying of a precious metal, gold or silver or platinum, is suitable for your circumstance and you wish to buy them, if you buy them through Smaulgld, I do get a small commission. You pay the same price you would pay if you went directly to the website. So it does help out. I do not charge for anything on the site. You get everything I produce for free. And so if you'd like to support the site, you can buy your precious metals, if you're so inclined, through the site. I did a quick podcast on Friday on Can Anyone Predict the Price of Gold? And I went, these are the Muppets here. You can see them. They're going to sell this pet rock to Goldman Sachs. It just goes through the horrendous job that some of the bullion banks and Martin Armstrong made last summer when they predicted that the gold price was going to go down, went the other direction. I also give examples of when they predict the price was to go up, price went down. So I view price predictions as somewhat of a fool's errand. Give examples there. I think next week I'm going to do one on journalists, which are even worse than banks and gold authorities. Journalists making predictions on the price of gold. I will do a similar comparison as I did in this video. Okay, let's get to the Fed yak attacks. All right, so basically the markets are ignoring the first Fed yak attack. They're looking at the data. They know the Fed says they're data dependent. Basically, the Fed has realized the dollar index is falling. Gold and silver are starting to move. Silver is over $20 an ounce. Gold is moving closer to $13.60, $13.70. So Boston Fed President Rosengren comes out and he backs gradual rate hikes. Now, he's a voting member, but he doesn't commit to timing, but he complains that asset prices are too high and the economy risks overheating if they don't move sooner or later. That's always true, that they should be raising rates gradually. That's what they said they would do, that they're going to normalize interest rates. They're never going to do that. They're just going to raise interest rates once or twice so that they can move the dollar index up. So the next time they want to do a QE, the dollar falls from a much higher point. But the economy is at no risk of overheating. There is inflation in the economy, but that inflation is in rent, housing, health insurance, food. But it's not a result of a robust economy where people are basically making so much money and chasing fewer goods and services because the production hasn't caught up. That's not what's going on. What's going on is you have asset price inflation just because there's cheap money. It's bidding up stock prices and real estate prices. Or government intervention forcing people to buy healthcare insurance also pushes the price of healthcare insurance up. So Boston Fed president is talking about a gradual rate hike. That spooks the market, probably more than they expected, but they got their dollar index increase. Then Fed Governor Daniel Tarullo comes out and he says he wants to see more evidence of inflation before a rate hike. What does that do? Just like when Fed Vice Chairman Fisher mentioned at the end of the Jackson Hole speech 2 Fridays ago, he wanted to wait to see next Friday's non-farm payroll. That makes people wait another week. They buy time. This guy says the same thing. Now he wants to see the CPI, the PPI, which come out next week, which means nothing is definitive. The Fed, the people, the market participants have to pay attention to the Fed, have to pay attention to what their next goalpost is. The next short-term goalpost is CPI, PPI. Next week, then they added this Brainard woman to the list. You're going to have Lockhart. He's the guy, the Atlanta Fed president, who's predicting a 3.5% GDP growth in the third quarter. Who knows why they're predicting that? And Cash Carey. But the reason the Brainard spooked people adding her to the calendar on Monday is she's one of these Janet Yellen followers who believes in a very dovish monetary policy. And adding her to the calendar people are starting to think, well, she's been added to the calendar. Maybe she's going to come out and pop off about the need to raise rates. So what the Fed's going to do now, maybe they didn't realize this, or maybe they know, but the stock market went down on Friday. If it goes down again on Monday, maybe they'll change their tune. Who knows? What the Fed is doing is very clever. What they're trying to do is control the game. If the markets crash, they've got a built-in excuse not to raise rates. But what they want to do is they need to maintain that dollar index to a certain level, and they need to maintain positive rates so that the U.S. Treasury can continue to sell Treasury bonds. Because after all, if the U.S. government issues bonds with a negative rate, why would you have a reserve currency? What would be the point of holding U.S. dollars other than you have to hold them to buy oil? But otherwise, there's more attractive places to park cash if you're going to lose money. So at least the U.S. pays a positive interest rate. That's why the Fed is not probably going to do negative interest rates unless it absolutely thinks it has to. And they'd be more likely to keep rates where they are, even slightly higher, and then go out and buy assets because they think somehow printing money and buying any and all assets that aren't nailed down somehow creates economic growth. But what people are thinking is that somehow that the Fed can normalize rates. It's never going to happen. All they're going to do is raise the rates if they have to, and just to gain their credibility so they can launch, their grander schemes later. Well, thank you very much for listening. Remember to subscribe to Smaulgld.com, stay in touch, and also to subscribe to the YouTube channel. Thanks for listening.